11,000 jobs have been cut at the social media giant Meta.
The largest job cuts in the company's history. He overinterpreted the pandemic, thought that things would continue to improve and grow for the company.
CEO Mark Zuckerberg estimates his company will be hit with a $10 billion loss this year.
I do think that Zuckerberg wants very much to get expenses in line with revenues, which would require even deeper cuts.
Feeling. I mean, I know that there must be just a range of different emotions. I want to say, up front, that I take full responsibility for this decision.
So the cuts that the Wall Street Journal did break the news on this past weekend, I would say around Sunday, actually now got announced. But the question that I had was that we had so little to go on when it came to sort of predicting this. What I'm going to show you next is the only commentary that we got which hinted at sort of large-scale layoffs. So they didn't really tell us anything in the Q3 calls. Here's that video.
In 2023, we're going to focus our investments on a small number of high-priority growth areas. That means some teams will grow meaningfully, but most other teams will stay flat or shrink over the next year.
So now that the layoffs have been announced and we've had time to digest them, there's 6 items that I want to walk you guys through about Meta in this video. The first item is that should we be expecting more layoffs to be announced in the near future? The second one is let's do a read through of Zuckerberg's email and try to pull out as much as we can from it. The third one is let's review the conference call that they had with the staff. The fourth item is how should we be thinking about costs in fiscal year 2023, both OPEX and CAPEX, and I'm going to show you how I'm modeling it into getting to the valuation. The fifth item is how reliable are our revenue estimates in this environment? And of course, the sixth one is once we can figure out sort of how to value that OPEX and CAPEX, what is the updated intrinsic value for Meta relative to its current share price? And so that's what we're going to cover in this video. And so while you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. And let's dive right into this one. So you can see that the expectations of higher profitability have shot up the share price combined with the news of lower levels of inflation. And so as you can see, Meta is up almost 24% today. And here's some interesting little tidbit of information. So I was just looking at how the media was reporting this, and what I found is that there are some commentators who actually believe that there's more layoffs on the horizon. Here's Jim Cramer making that point right now.
I think that, first of all, this is the worst performing stock in the S&P 500. I do think that Zuckerberg wants very much to get expenses in line with revenues, which would require even deeper cuts. I think that it's going to happen. I think that there's actually, to some degree, a concern about what shareholders think.
Now, Jim Cramer's rationale as to why there'd be more cuts is because he believes that Meta is now paying attention to what shareholders are thinking. Now, personally, I don't think Meta ever stopped caring about what shareholders are thinking, but they just care so much about their vision, especially the AR part of the metaverse, from my opinion at least, because that's the part of their whole metaverse that I think has a lot of legroom. And what I mean by that is replacing my personal PC with sort of their augmented reality headset. And so instead of buying 6 monitors, I'm looking at 4 monitors right now. You guys can't see it because of the camera setup, but I do have 4 monitors here, and I use this on a day-to-day basis. And so I believe that management is sacrificing profitability in the near term to get to that vision before anybody else. But what Jim Cramer appears to be saying right now is that because management, in his opinion, is now paying more attention to what Wall Street thinks and less attention to their overall goal, they're going to start laying off even more people. And that doesn't make a lot of sense to me, especially in an environment where they're so cash flush. They're not raising capital. They're not issuing equity. So I don't know if this makes sense. And Jim Cramer's colleague actually calls him out on this. Watch this call out.
Wait a second. We know that there isn't, from what they just decided to do with their last quarterly report, spending at Reality Labs through, as you pointed out, free cash flow.
Periodically, there's changes of mind.
Do we really think this is a change of mind, or is this sort of already established as something that would occur?
I think that there's some tension between the CFO, who I think got a little blast from some people after that last quarter, and Mark Zuckerberg, who I think have been somewhat oblivious or no, wait, let's just say not oblivious. Not concerned.
And so Jim Cramer's rationality there was that their CFO really got the hammer from the investment community, and Mark Zuckerberg was sort of like uninterested in what sort of the investment community was looking at, but now Mark Zuckerberg is more interested in it. So I don't know if that was good rationale or good reasoning. And so once again, his colleague calls him out again and forces Jim Cramer to really provide his thoughts on this.
Jim, this is important because if this is the first sign that Zuckerberg is starting to give in, so to speak, and say, okay, I've got to run this once again more for profitability in the near term.
Not near term, over the next year.
Over the next year, that would seem to indicate then that he's not going to spend it all, costs whatever it is, on the metaverse. Or are we not there yet?
I think we're there.
You do.
So Jim Cramer concludes that they're not going to spend on the metaverse. Now, my opinion is that I don't think that Jim Cramer is thinking this through right now. I think he was just thinking quickly with the camera in front of him. But from my perspective, I think what's really going to happen is you're not going to have large-scale layoffs announced again unless there's a huge deterioration in the economic environment, which could absolutely happen. And so what's the move forward here? I think there might be small layoffs at various teams. There might, of course, be certain projects that get thrown away, but I personally don't see additional large-scale layoffs from Meta, but I could absolutely be wrong, but I just don't see multiple large-scale layoffs. That would be horrible in my opinion for the employee morale at Meta. And you know what? It already has been tough because Mark Zuckerberg came out a couple of months ago and he said there's a lot of people that just don't belong at Meta, and you don't ever want to hear your CEO say something like that. And so I presume that sort of the morale was already hit a little bit. People were on edge, and now the axe has come down on 13% of the overall company. And so if it happens again, I think you're just going to lose a lot of your best talent because they're the ones that have the best options, and they don't want to be somewhere where they could be out of a job tomorrow with just 4 to 6 weeks. And so they got to really be careful with the way that they phrase it. And this is why I don't believe that they're going to have another round of large-scale layoffs unless, of course, there's a huge macroeconomic slowdown. But this is a point that I want you guys to opine on. Let me know in the comments what you guys think. I learn a lot from you guys. And for the most part, I've just kind of been putting words in Meta's mouth or Mark Zuckerberg's mouth. So here's Mark Zuckerberg announcing the layoffs with his own words.
I'm the founder and CEO. I'm responsible for the health of our company, for our direction, and for deciding how we execute that, including things like this. And this was ultimately my call, and it was one of the hardest calls that I've had to make in the 18 years of running the company. And a lot of why it's hard is, obviously it has a big impact on your lives, but also for our mission, we're losing people who you've really put your heart and soul into this place, and each of you is talented and passionate, and each of you has played a role in making Meta the success that it is. And no matter what team you may have worked on, each of you played a role in contributing to the products that billions of people use to connect every day.
Now, I absolutely don't envy him. Now, I'm a senior leader in tech, in the finance space at least, and I've been on both sides of the hammer, and I'm sure you guys might be able to relate that it's not fun to be on either side of it. And so what I want to do next is go through the formal letter that he sent out to his employees. So let's dive into that. So you can see here that he started his letter off by saying that, he's decided to reduce the size of the team by about 13%, which means that he's going to let go approximately 11,000 people, and they're taking a number of additional steps to cut discretionary spending and extend their hiring freeze through Q1 of 2023. And so what this means for us is that when it comes to fiscal year 2023, we have to sort of start thinking about how will we sort of forecast out that OPEX and that CAPEX. And so I have a view, and I'll let you guys know once we get there. And speaking of getting there, Mark actually in his email started off by saying, how do we get here? How do we get to the cuts? And so he went on to say that many people predicted that this would be a permanent permanent acceleration, which was sort of like that COVID surge, and that acceleration in the online space would continue even after the pandemic ended. And so what he's effectively doing here is saying that he drank the Kool-Aid. He believed that the surge that was experienced during the pandemic was sort of like a pull forward, and it was a permanent pull forward, and it wouldn't go back to sort of the pre-pandemic growth rates. And so I don't know if you can really blame him for that, because a lot of people believe that. Even I believe that. But the reason why I sold Meta at around $300 is because it was more of a valuation thing. I just didn't think that it was a compelling discount to its intrinsic value. And so that number 4 tenant of Warren Buffett, it saved me in this situation. I ended up walking away from this with a profit, but doesn't necessarily mean that I was right. I sold it from a valuation perspective. I didn't sell it from a perspective where I thought that the company might be overestimating and the investing community might be overestimating the future prospects for the company. And so I want to be fully transparent with you guys, because this was a shortcoming of my own and I just happened to make money here. And so he continued on and said that not only has online commerce returned to prior trends, but the macroeconomic downturn, increased competition, and ads signal loss, so that's that Apple iOS issue, has caused our revenue growth to be much lower than I'd expected. Now, the first thing about that Apple iOS issue that I really got to bring up is that this is where I start questioning my revenue growth rates for the future. And so I'll discuss that in more detail later on in this video. And so he goes on to say that we've cut costs across our businesses, including scaling back budgets, reducing perks, and shrinking their real estate footprint. And he goes on to say that while they're making reductions in every organization across both Family of Apps and Reality Labs, some teams are of course going to be more affected than others. Obviously, if they're not hiring, recruiting will be disproportionately affected. And that's not just happening at Meta, that's happening all over the place, since of course they're planning to hire fewer people next year. And here are some additional changes that they're making. They're currently in the middle of a thorough review of their infrastructure spending as they build out their AI infrastructure, and they're focused on becoming even more efficient with capacity. So what this particular item speaks to is how much of that additional CapEx spend that they forecasted out into 2023, which they told us was related to that AI infrastructure and not to Reality Labs. Don't listen to what people will tell you. Listen to exactly what they're telling you in their conference call. How much of that will be scaled back? I think that they need to continue to do what they said in their conference call for the Q3 conference call, and go back and read that if you missed it. I did a 30-minute video on it where I walked you guys through it, and so you can watch that video, which I will link at the end of this video. But I really think that what they should do is continue to determine if that's as profitable as they think and scale up or down investments based on that. I think their plan was solid on that. I don't think that they should scale it back if it's profitable, because they're trying to just reduce costs as a whole. But fundamentally, what they're saying is that we're making all of these changes for two reasons. One, our revenue outlook is lower than we expected at the beginning of this year, and we want to make sure that we're operating efficiently across both Family of Apps and Reality Labs. Now, what I don't understand is why wasn't any of this said in the Q3 conference call? Why did they wait just a couple of days after the Q3 conference call to announce this? It's not like they didn't know that they were going to be making these cuts, but they may just not have been prepared, and so I accept that, but it's just really weird that it happened the way that it did. Now, when it comes to how they're moving forward, I wanted to highlight this one sentence here. Mark Zuckerberg does believe that they're deeply underestimated as a company today. Billions of people use their services to connect, and their communities keep growing. Albeit, I will say that their communities are growing at a slower rate. You are getting international growth, but you're not necessarily getting North American growth, and that's fine. My question is, how should we be thinking about revenue growth into the future? And here's where I'm going to show you my model, which you can get access to at the lower tier of the Patreon level, at just the $5 level. You can see that this model, I'm essentially, what I'm doing is I'm forecasting a revenue decline this year, so fiscal year 2022. And then notice that in fiscal year 2023, I'm forecasting a modest revenue increase in line with what I think inflation will be. So I'm effectively just saying that Meta will increase their prices alongside inflation. That might actually be optimistic, especially if we go into a recession, which is what pretty much everybody's predicting. And so my model might be a little bit optimistic there. And then thereafter, I'm saying in 2024, we have a recovery, and Meta is able to grow their revenue at approximately 12.5%. And what that 12.5% really reflects is the success with Reels and the success with AI, which is driving more impressions and keeping people using their family of apps longer, plus the resurgence of pricing on their platform. However, I gotta admit to you guys that I'm becoming more uncertain about the future revenue growth rate in light of the recent disclosures provided by the company. And so this is a stay tuned and see type of story. And the major item that's sort of concerning me right now is the fact that they brought up that Apple iOS issue. Now, they have come out and said many times that it's not as bad as we originally thought, but now they just brought it up and called it as one of the reasons why they're cutting 13% of their workforce. And so now I'm putting Meta's management kind of in the penalty boxes. I don't really know how to think about these risks going forward. And so should I just completely wipe out that 12.5% and just say that they're just going to grow at 5% thereafter? Because that's going to bring my valuation way down. I want you guys to tell me what you think on our next monthly call, which we will have at the end of the month. I'm very interested to know what you Patreons think. How should we be thinking about modeling revenue going forward? I'm sort of lost. I don't really know. Now, I know that some people watching this video will comment and say, look, Facebook is melting down. You should never invest in it, blah, blah, blah. This month was a tough month for layoffs. And so Facebook is melting down, but note that everyone drank the Kool-Aid. It was difficult to predict the decline in online advertising market. And so you can see there's quite a few names that have announced layoffs or some sort of freeze. So obviously Twitter, that's more of a one-off issue because the new ownership took over, obviously Elon Musk. Snapchat, they're reducing their hiring counts by 20%. I just tried to pick out sort of like the ad spending names. Shopify is down 10%. And then, of course, Amazon is under a hiring freeze. Now, the next hatchet to come down, I do believe, is Amazon, especially as sort of the Q4 spending becomes a little bit weaker than what we expected. Amazon already said that it's going to be weaker than expected, but I wonder if they revise their estimates and it comes down even further. And so the next question is, how should we be thinking about the cost structure going forward? Well, notice this is once again the model that the Patreons get access to. I've already put this Reuters note in here, so you can actually click into that total costs and expenses, that 96,203, and you'll see the note in there. So subsequent to the cut of 13% of its workforce, Reuters actually reported that the company now expects 2023 expenses between 94 billion and 100 billion, and which is compared with the 96 to 101 billion range, which was projected previously. And so it also narrowed its 2023 capital expenditures forecast range, but I don't actually have a number for that. And so you can see that I've actually brought down their total costs and expenses as a percentage of revenue to around 80% in 2023. So you can see that their cost structure is still going up as a percentage of revenue in 2023 despite these cuts. And so what that should tell you and trigger in your mind is that the valuation for Facebook is not going to end up going significantly higher in this environment. And I'm going to show you that next. And so here's the valuation model for Facebook or Meta. So you can see that the valuation is approximately $160 per share, $157.56. The previous valuation that I had on Meta was approximately $150 per share. So the valuation only really went up by $8 per share, and I haven't factored in any of the massive cash charges that they're going to be liable for, which I should deduct from the excess capital per share line for all of the severance that they're going to have to pay. So the share price as a percentage of the valuation is not cheap. It's around 65%, but that's because the current share price ran up considerably. But this is still not a stock that I would want to look at for anything over $75 per share. So there it is. That's kind of how this sort of all plays out. I don't buy into the hype that now's the time to buy Facebook. I know a lot of people are, especially in the value investing community, but I'm sort of cutting through all of that right now and thinking about the fact that there are a lot of risks on the horizon. We don't know how to forecast revenue. I don't think costs are being cut as deeply as we would have originally anticipated with 13% of the workforce being cut. Here's where Jim Cramer might be right in that they might be doing further cuts to really bring down that cost as a percentage of revenue. So we'll see if that sort of plays out. But if you want even more detail on sort of how Meta works and a full model walkthrough, I actually made a full 30-minute detailed model on Meta going through their Q3 results. So this will give you the complete story, and you can get to that video right here.